We want to start with the big driver of the market this morning, and that is the bank earnings that we got out. JPMorgan coming out of the gate very strong with its third quarter results. We're looking at gains of just about 1.5% in the pre-market. Revenue beating the street at $40.7 billion with adjusted earnings per share of $4.33. Net interest margins helping the numbers here. CEO Jamie Dimon calling it a, quote, solid quarter, also adding that these results benefit from our over-earning on both net interest income and below normal credit costs. Lots to digest in this report here, Brad, but clearly from looking at these numbers, especially the headline numbers, once again, JPMorgan really showing its dominance and why it is the leader here when it comes to the U.S. banks, at least right now. What stuck out to me, though, wasn't necessarily the headline numbers. Sure. It was some of the comments that we heard from CEO Jamie Dimon. And in this, he talked a lot about the economy, the consumer, saying that the consumer and businesses are healthy, but he did warn that interest rates may continue to climb even further from here. But perhaps what was most notable was what he had to say about some of the geopolitical headlines today, saying that this may be the most dangerous time the world has seen in decades with Israel and Ukraine. He also went on to talk about the attacks on Israel and the war in Ukraine, how that could have far-reaching impacts on energy and food markets, global trade, and geopolitical relationships. And I bring that up because clearly a massive, massive issue. When you talk about the ripple effects of this, what it could mean, obviously much more far-reaching than just the banks. When we're talking about the business impact, obviously, not the human impact, the business impact of all this, far-reaching, and almost every industry could be touched, if it has not been touched, by the growing conflicts right now. Yeah, absolutely. And it continues to keep in mind a few of the things that the Fed has no control over. Yeah. The Fed does not have any control over geopolitical tensions that put further pressure perhaps on inflation. We have yet to really see that show up in the data. However, that is where a lot of the economists' thought process has gone. We're going to continue to discuss that with one of our guests later on during today's show. But particularly here in those comments, and I think you were right to point out really two of the big things that the Fed does have in its purview, and that is the consumer as well as the labor market right now, because he addressed Jamie Dimon saying we still do not know the longer term consequences of quantitative tightening that the Fed has gone down that pathway of, reduces liquidity in the system at a time when market making capabilities are increasingly limited by regulations here. But also here, you think about the consumer, saying the consumers and businesses generally remain healthy. However, consumers spending down some of their excess cash. We've continued to hear that time and time again, that the consumer might not be breaking, but they are certainly bending and showing more signs of that. And then just lastly here on the tight labor markets here that we're continuing to track, JPMorgan CEO Jamie Dimon saying tight labor markets persistently, as well as extremely high government debt levels with the largest peacetime fiscal deficits ever, are increasing risks in their purview that inflation remains elevated and that interest rates rise further from here. So that is squarely what CEO Jamie Dimon, who previously was taking on a little bit of the meteorologist hat and giving us the economic weather report, but really being pointed in some of the language and the statement that he provided with today's earnings, even as we track JPM shares here pre-market. As of right now, we were just showing them to our viewers a moment ago, but for JPMorgan this morning, at least right now, pre-market, we're seeing a gain of about 2%. Speaking of some of the bank earnings that we're tracking here today, we got to talk about Wells Fargo. Higher rates also boosting Wells Fargo, the fourth largest U.S. lender, took home $13.1 billion in net interest income during the third quarter. And it boosted its forecast for that figure. Total revenue beat expectations at $20.9 billion during the period. CEO Charlie Schwab said that while the economy has continued to be resilient, we are seeing the impact of the slowing economy, with loan balances declining and charge-offs continuing to moderate modestly. And so that in some of the numbers from Wells Fargo. But again, here, I think when you think about Wells Fargo and where within some of the line items that I was tracking in the segment operations, they did see decline in some of their segments here, year over year at least. And you think about the consumer banking and lending, it looked like that was down by about 10%. You looked at the commercial banking segment that looked like it was down by about 11%. So all in here, there are still, and especially within the wealth and investment management, and that could show where some of their customers are taking money off the table, especially coming off of August and September, which were certainly two of the more dismal months over the course of this year. Yeah, certainly very important to point out there, Brad. And what's really sticking out to me, that the net interest income number there increasing 8%, primarily due to the impact of higher higher interest rates, obviously something that we heard from JPMorgan in their report as well, saying that though was partially offset by lower deposit balances. Another thing that sticks out to me was the provision for credit losses here in the third quarter, including $333 million increase in the allowance for credit losses. This is primarily for commercial real estate office loans. We talk about their exposure there to the space, what that means for the business here going forward. They also said that they also attribute it to higher credit card loan balances, which was partially offset by a lower allowance here for auto loans. So again, a good look at the consumer, a good look at commercial real estate right now, exactly what that play looks like here for these banks who do have exposure, more exposure maybe than some of the others here. But also what CEO Charlie Scharf has said about the economy, right?
Yeah.
Once again, yes, the banks are doing okay so far. Higher rates have been able to navigate the environment up until this point. But when you take a look at some of the spending patterns or some of the things that they're noting here about the consumer, the possibility for further weakness seems to be a common theme in these reports this morning. Well, we're not done yet because we also heard from Citi. So let's talk about those results here. Citigroup beating the street's expectations in the third quarter. Revenue landing at $20.14 billion. Now, it was strong growth with both institutional clients and personal banking customers. The numbers come at a pivotal time as Jane Fraser enacts an ambitious turnaround plan. We're talking about what went into Citi's results here for the most recent quarter. That revenue beat with both institutional clients and personal banking showing some strength. Their institutional clients, they reported revenue of $10.6 billion. That was up 12% on a year-over-year basis. Personal banking and wealth management division generated $6.8 billion in revenue, up roughly 10% on a year-over-year basis. Loan loss provisions coming in at $1.84 billion. So that was just a bit up here, up slightly from $1.82 billion at the end of the previous quarter. But like I said, one of those themes here of this earnings season, at least right now, it's day one here for the banks, but a theme at least this morning, CEO Jane Fraser saying that continued deceleration in spending indicates an increasingly cautious consumer.
This is a bank that's also restructuring itself right now, too. Jane Fraser acknowledged that within a statement. I mean, at that mid-management level, it seems like there are going to be more cuts that continue to be enacted as of right now as part of that previous announcement, saying that last month we announced those consequential changes that align our organizational structure with our strategy, changes how we run the bank, and then when they completed, they ultimately see themselves as a simpler firm, operating faster, better serving clients, unlocking value for shareholders. Shareholders want to hear that this morning. However, at the same time, it's a larger question and perhaps answers some of the questions around where they see themselves moving towards here and the areas that they're going to continue to maintain either the same amount of headcount or invest further in. You think about one of the segments that's been extremely important for them, this strength across the services and markets in institutional clients group, what they call the ICG here, plus the U.S. personal banking within that personal banking and wealth management business here. Revenues increased 9% from the prior year period, largely driven by that. And so that's perhaps giving a little bit of the inclination this morning of where this business and where the leadership is going to continue to lean into, even in spite of some of the organizational changes that they've had to make.